Good morning and good afternoon, everyone. I'm Justin Ditkofsky. I'm the Vice President of Healthcare Leasing at Cirrus Consulting Group. We are also joined this morning by Casey Hiers from Four Quadrants. Casey, are you with us as well?
I am. Thank you, Justin.
Wonderful. Well, everyone, I'd like to thank you all for taking the time to join us this morning or perhaps this afternoon. I know we have various doctors from all over the country. We have a number of doctors from the West Coast, doctors from the East Coast, and various doctors from various parts of the country, as well as it looks like we have a few doctors attending from Hawaii as well as Alaska. So lots of different time zones. So whether it's the morning or afternoon, I do certainly want to welcome you all to today's webinar. We are going to discuss over the next hour or so quite a bit. We're going to start off with a conversation about commercial real estate and lease negotiations, followed by Casey will take over and talk more about business management and financial management and essentially how do you operate your businesses more efficiently from a financial standpoint. So to give everyone a little background on Cirrus Consulting Group, I know some of you may be familiar with our firm, others may not. We've been in business for 24, going on 25 years now. We are a healthcare specialized tenant representation company, essentially specializing very specifically in representing, advising, and counseling dentists in commercial real estate matters, primarily getting involved in the negotiation and renegotiation of office lease agreements. Our firm is unique with the respect of how we're structured. We do have an in-house legal team comprised of real estate attorneys, all of whom specialize in healthcare tenant representation. We have an in-house leasing team who are able to do research on rental rates, comparables, essentially take a look at the local real estate market in any market across the country. And then we have an in-house consulting team. Our consultants work very collaboratively and in parallel with our legal and leasing team to ensure that our clients are properly advised and represented with respect to the strategy for the negotiation or renegotiation of their office lease. And we work with a variety of different doctors in different stages of their career. So we do work with various medical doctors as well as veterinarians. However, our core business is dental. Our clientele are probably 90% dentists, the remaining 10% being medical practitioners and various veterinarians. And we work with doctors who are starting new practices, who need help with identifying locations, negotiating financial terms, negotiating legal terms, and limiting liabilities. However, I would say the majority of our clientele are doctors who've been established for many years, are in a leasehold arrangement. In other words, they rent or lease commercial real estate for their business, and they have a lease agreement either expiring or approaching a renewal date within the next 1 or 2 years, and we are retained to essentially represent them and renegotiate terms on their behalf to essentially save the practice as much as possible by reducing occupancy expenses and rental expenses, but also a big focus is to structure the lease agreement legally to limit liabilities for you, your family, your estate, but also, very importantly, ensuring that the lease agreement is structured in a way to facilitate an eventual sale of your business. So we will spend some time actually this morning discussing how the lease agreement is relevant to the sale and or acquisition of your practice. However, again, just to give you a little background on the firm, that essentially is our expertise representing dentists in commercial real estate matters. Annually, we will represent more than 1,000 doctors across the country. We also lecture quite extensively and do lecture at many of the large national dental conventions and conferences and trade shows. And really the purpose of today's webinar is to, first of all, discuss how to save money and whether or not you are overpaying in rent and other occupancy expenses. We're then going to discuss how to identify some of the risks and liabilities within your lease agreement and how to effectively amend your lease agreement during a renewal or negotiation of your lease. We're going to have a conversation about common area maintenance fees, which I know is a particular concern for many of you as these costs tend to increase over time while the management of the building deteriorates. And lastly, we're going to determine, essentially have a conversation about determining return on investment on the real estate component of your business. So I always like to start the conversation off really just talking generally about what a lease agreement is. Now, I would imagine for many of us, we have been practicing for many years or potentially have been practicing for many decades and likely are very well aware of what a commercial lease agreement is. However, it's important that you understand that your lease agreement, particularly for you as a dentist, is far more than simply an agreement that outlines your terms and obligations as a tenant in the building. In fact, the reason that I put up a check is because for the average dentist across North America, rent is generally one of the bigger overhead expenses for the practice. The first obviously being payroll and staff wages. The second is arguably either rent or occupancy expenses or sundries and supply expenses. So very common when we talk about commercial leases for most practitioners and most practice owners to think about the overhead costs that they incur to lease their space. In fact, one thing that I encourage all doctors to do, whether they are signing a lease for the very first time or have a lease agreement coming up for renewal, it's important that you understand that the lease agreement is far more than simply a contract that outlines how much you pay per month in rent, how many years of term you're committed to, and who you're paying. In fact, it's arguably one of the more expensive checks you'll ever write in your career. If you normalize how much you pay in rent in 1 year, and then you calculate how many years you practice dentistry for, albeit 10, 15, 20, 30, 40 plus years, and you start to give some thought to how much you will, what type of expenses you'll incur in terms of leaseholds and rental expenses over your career in dentistry, for many of you, that is a seven-figure number. We're talking north of $1 million or $2 million in terms of rental and occupancy expenses over your career in dentistry. So it's essential that the lease agreement is properly structured, not only to minimize costs and expenses for the business, but also to be structured in such a way that liabilities are limited for you, your spouse, children, and estate, but also ensuring that the lease agreement is structured in a way where it'll facilitate an eventual sale of your business. Now, the lease agreement is particularly relevant for all of you because first and foremost, as a dentist, the location is really the foundation of your business. I say all the time to all of our clients and prospective clients that no location, no practice, and no facility, no practice, no facility, no business, and no revenue. So at the core of your business, the location is really the foundation of your business. And it's essential that the lease agreement is structured in a way to give you long-term predictability and stability in your space. Additionally, it is awfully expensive to build a dental practice. As I'm sure many of you would agree, dentistry is incredibly capital intensive, but particularly opening a new practice is incredibly expensive. For most of you, the average dentist will invest upwards of $100 to $200 plus per square foot simply in leasehold improvements to design and build their office. What I mean by that is if you're leasing a 1,500 square foot or 2,000 square foot space for your practice, most of you will be spending upwards of $100 to $150 or $200 plus per square foot simply in construction costs to improve the space, put in the necessary plumbing, electrical, and infrastructure for a dental practice, which means it's essential that the lease agreement, again, give you the long-term predictability in the building to avoid the cost of picking up and moving. It is also, as many of you I'm sure can appreciate, and some of you unfortunately have probably experienced, it is incredibly difficult, expensive, and time-consuming to relocate a dental practice. And for that reason, again, very important that the lease agreement protect you and give you the predictability to stay in your property long-term. And lastly, as many of you may know or some of you may learn in the coming years as you do transition and plan for an eventual retirement and sale of your business, the lease agreement is very relevant to the sale and acquisition of your practice. In fact, for any of you considering buying or selling a practice, and this is very specific to general dentistry, there are three variables that will factor into practice value. The first and foremost obviously being equipment or the depreciated value of the equipment. For the most part, goodwill will determine the biggest portion of sale value or the appraised value of your business. Goodwill really being a function of revenue, gross revenues, operating expenses, not net operating income or profit. And generally, for many of you, the value of your business will be a multiple of earnings or some type of calculation based on gross revenues for the business. However, when your business is appraised, the equipment, there will be a tangible value attributed to equipment. There will be a value attributed to goodwill, again, purely based on incomes and revenues and profits of the practice. But generally speaking, when you sell a dental practice, you're selling the equipment, the goodwill, and the facility itself so that the incoming doctor is essentially purchasing a guaranteed revenue stream. And for that reason, the lease agreement will factor into the valuation of the business. In fact, in many cases, as I'm sure some of you have probably heard from friends and colleagues, if the lease agreement is not structured properly, it can actually not only impede the sale of the business, but in some cases jeopardize the sale entirely. So as we discuss leasing, and we'll talk at a very high level about the practice, sale, and acquisition process, it's important that you understand the lease agreement does have the ability to make or break the sale of your practice, which is why we recommend to anyone considering purchasing a practice, considering selling a practice in the next 5 or 10 or 15 years, to ensure the lease agreement is structured in a way to not only facilitate the sale, but enhance the attractiveness of the business while limiting liabilities. Now, what your lease agreement really should do for you is, first of all, your lease should provide fair and affordable financial terms, which is really part of our discussion this morning. Now, when we talk about fair and affordable financial terms, it's important that you understand in commercial leasing, it's not all about rent. The base rental rates in commercial leases are really only one of many financial variables in the lease agreement. Generally speaking, most commercial lease agreements are structured in a way where you are paying on a monthly basis rent. In addition to rent, you're also paying operating expenses, generally referred to as common area maintenance charges. And the way that most leases are structured, they are a triple net lease agreement. Triple net lease meaning that on top of the rent you pay on a monthly basis, you will also pay your proportionate share of property taxes, common area maintenance charges or maintenance fees or operating expenses, as well as insurance on the building. Your proportionate share being calculated based on the amount of space that you're leasing by proportion to the total square footage of the building. So for example, if your space is 1,000 rentable square feet and the building has a total of 10,000 rentable square feet, you'll be responsible for 10% of property taxes, 10% of common area maintenance fees, and 10% of insurance on the building. However, it's very common that many buildings will actually overcharge when it comes to common area maintenance fees or property taxes. For that reason, it's essential that the lease agreement is structured in a way where it will not only provide you with the ability to request detailed and itemized statements, but also have the ability to audit statements as it relates to operating expenses, common area maintenance fees, and charges to ensure you are not being overcharged. Your lease agreement should also provide you with long-term stability and security. So we talked earlier about the fact that we want lease agreements to be structured in a way where it gives you the peace of mind that you can practice in your space and your facility for the long term. However, generally speaking, many lease agreements are structured where you only have a few years of predictable term, albeit a 2 or 3 or 5 year term, and it's a little bit of murky water beyond that in terms of if you'll be able to remain a tenant in the building, or if the building may be sold or being primed for redevelopment. So the way that you ensure your lease provides you with long-term stability and security, and our recommendation is generally to have a more long-term lease in place. And what I mean by a more long-term lease in place is to ensure that, ideally speaking, you have a 10-year term with 2 5-year renewal options. So 10 plus 5 plus 5. The reason we recommend that is twofold. First and foremost, when you're negotiating a commercial lease with any landlord, whether it's a sophisticated institutional landlord or a less sophisticated family-operated property. Most property owners are inclined and motivated by long-term commitments with tenants in their building, particularly stable, trustworthy tenants like dentists who generally pay their bills and very rarely default on their lease obligations. And it'll provide you with the necessary leverage you need to negotiate favorable financial and legal terms. Secondly, by having a more long-term lease in place, it actually will facilitate the ability for you to eventually sell your practice. The reason being, when you sell a dental practice, most lenders or banks tend to be fairly lenient with financing the acquisition of the business because of the predictable nature of a dental practice, in terms of being fairly stable regardless of the fluctuations within the economy. However, banks are very risk adverse. And what most lenders will do is they will amortize the term of the loan for a practice acquisition over the term of the lease, meaning if your lease agreement expires in less than 5 years, it is generally very difficult, if not impossible, for a lender to finance the purchaser for the acquisition of a practice. So by having a 10-year term or a 5-year term with multiple 5-year renewal options, not only are you getting leverage in the negotiations by offering the landlord something that's attractive to them, you're also structuring your lease to provide you with long-term stability and security while actually enhancing your ability to eventually sell the practice. Your lease should also minimize risk and exposure. Unfortunately, for many of you, you have structured lease agreements where you have provided a personal guarantee on your lease. A personal guarantee essentially implying that if there was some type of dispute between you and your building owner, they would have the ability lawfully to pursue legal actions against you personally, including pursuing legal actions against your estate. So from a legal standpoint, it really leaves you in a very vulnerable position because all of your personal assets, your home, car, investments, and so on, are essentially collateralized under the lease. So one way that we recommend minimizing risk and exposure is if you have provided a personal guarantee, which unfortunately many of you have, the guarantee can be removed from the lease during a renewal or expiry of the lease, or limitations can be structured in the lease to minimize the risk and exposure and essentially limit the liability. The other way that you minimize risk and exposure, and something that we pioneered roughly 20 years ago, was incorporating a death and disability clause in your lease agreement. A death and disability provision is essentially a provision in your lease agreement that enables your family and or estate to terminate the lease should you become disabled, incapacitated, or God forbid pass away and can no longer practice dentistry. Think of it as kind of an insurance policy that is built into your lease, however, you do not need to pay monthly premiums for. So we pioneered the death and disability provision 20 years ago. Again, it protects your family. So God forbid something happens to you, your family has the ability to terminate the lease if need be. It's also transferable to a prospective purchaser of your practice, which will, again, enhance the attractiveness of your practice. But the real benefit of the death and disability is minimizing risk and exposure and liabilities to your estate, God forbid something were to happen to you. Your lease should also maximize flexibility, and there's a number of ways to maximize flexibility. One very simple way is to incorporate a right of first refusal into your lease. A right of first refusal essentially provides you as a tenant with the ability to take on additional space in the building if need be to expand your practice, or alternatively, for those of you who are in smaller privately owned buildings, it'll actually provide you with the option to purchase the building. If the building is listed for sale, the owner will be required, per the terms of the right of first refusal, to offer you the building to purchase before they list it publicly and before they actually proceed with the sale to another party. So it's a wonderful clause to have in terms of maximizing flexibility. And in essence, if you start to structure the lease properly, where you have fair and affordable financial terms, you have the ability to request detailed itemized statements as it relates to operating expenses, you have long-term stability and security in your lease in the form of a long-term commitment with renewal options, you have limited liabilities, you have terms that provide you with additional flexibility, your lease will start to function more as an asset as opposed to a liability and will actually enhance the attractiveness of the practice. Now, there are a number of very unreasonable operating costs that many landlords will charge or incorporate into your lease, which is why, again, it's essential that we have the right, per the terms of your lease, to request a detailed itemized statement and the ability to audit that statement to ensure accuracy as it relates to operating expenses. We incorporate this into almost every lease for all of our clients. And for many of our clients, they may see no change in operating expenses because the landlords have been very diligent and honest with their accounting and statements and so on. However, generally speaking, many of our clients will see some type of decrease in operating expenses. It could be something marginal, a few dollars or 10 or 20, plus dollars per month. However, we have seen cases where it has actually reduced the total monthly expenses by hundreds of dollars per month over a long-term commitment. So essential that we have that in the lease, which again will make the lease function more as an asset as opposed to a liability. Now, as we talk about what's actually in your lease agreement, I wanted to just share with you, I guess in the interest of time, really one provision in particular. The clause you see before you is an assignment provision. An assignment clause is essentially a provision in your lease agreement that allows you as a tenant to assign or transfer your rights under your lease agreement to another person or party. This is very relevant for all of you who are contemplating an eventual transition, either to purchase a practice or are planning to eventually sell your practice, as this clause will dictate your ability to transfer the lease to another person, likely a purchaser of your practice. Now, it's very common in commercial lease agreements that if you do want to transfer or assign your lease agreement, you do need the building owner or property manager's approval. Now, generally speaking, most assignment clauses are structured the way you see it before you, where you do need the landlord's consent. However, the landlord does have the ability to arbitrarily grant or withhold consent. However, some of you may have it structured in your lease where it will stipulate the consent will not be unreasonably withheld. We are big advocates of removing as much, if not all, ambiguity from commercial lease agreements. As it relates to consent, it's very common and reasonable for landlords to want to control the incoming tenants in their building. The logic behind it is they do not want you transferring your lease to someone who has a criminal history or would simply just not be a good fit in terms of the other tenants in the building. However, what we've seen very regularly over the last 5 to 10 years is many landlords, again, sophisticated and less sophisticated landlords, are actually leveraging their control over the assignment or transferability of the lease agreement for self-motivated reasons. So we're working on a case right now that's a perfect example. We are actively representing a general dentist in Burlingame, California. This is just outside of San Francisco. She has been practicing for many years and essentially for various health reasons is now in a position where she needs to sell her practice relatively quickly. A few months ago, she had the practice appraised, north of $1 million appraisal, very healthy practice, high-performing practice, lots of new patients and so on, and a pretty attractive location. She has essentially formalized a conditional agreement with a prospective purchaser. And about a month ago, before she connected with us, she had approached her landlord as well as property manager to request their consent to assign or transfer the lease agreement to the doctor purchasing her practice. And in this particular case, the landlord advised her that they would only consent or allow a transfer of the lease agreement conditional on a 50% increase in rent, as well as they were expecting 25% of proceeds from the sale of the business. So this is a pretty extreme case. We have been, for the last month or so, going back and forth with the landlord. However, we are really at a disadvantage in the negotiations because, ideally speaking, what this particular client should have done is they should have proactively amended the assignment section in the lease to remove the landlord's ability to incorporate unreasonable conditions to allowing a transfer of the lease. And had that occurred, we could have avoided the scenario entirely. Now, I will tell you that this case in Burlingame is one of the more extreme cases. It's not every day that we're dealing with cases where landlords are asking for 50% increases in rent rates or conditioning an assignment of the lease on receiving or collecting 25% of sale proceeds. However, on a regular basis, and by regular basis I mean multiple times per day, we are seeing less extreme cases where landlords are leveraging their ability to assign the lease agreement and their ability to control the assignment of the lease to receive some form of cash goods or consideration, generally in the form of an increase in rent and or proceeds from the sale of the business. And when I say less extreme, I mean sometimes we're seeing cases where landlords are asking for a 10, 15, or 20% increase in rent. We're working on a few cases right now where landlords are asking for a few percentage points from the sale of the business. However, our position is not reasonable in any way for landlords to request any portion of the proceeds from the sale of your business. However, the way that that situation is avoided is by ensuring that the assignment and subletting section is properly structured. The other thing that you'll likely notice is it does stipulate in many assignment clauses that if you do request the landlord's consent to an assignment of your lease, the landlord does have the right to terminate your lease or to revise the minimum rental rate. It also goes on to say further, and this is very common in most commercial leases. In fact, from experience, 90+% of you this morning will have a very similar provision in your lease, whereby even after you have assigned your lease and sold your business, you will continue to remain a guarantor jointly and severally for the new doctor who has purchased your practice. In essence, you will remain a guarantor even after you have retired. So it's essential that when we talk about ensuring the lease agreement is properly structured, the assignment clause is only one of many terms and provisions in your lease that need to be structured to protect you, your family, your estate, and your retirement plans, but also ensuring that you have fair and affordable financial terms and that your rental rates and occupancy expenses are reasonable. For those of you who have already signed your lease agreement, it is not too late to assess the lease agreement and potentially renegotiate terms. In fact, for any of you who are currently operating under a lease agreement, we do highly recommend that you commence the process of opening conversations and negotiations with your landlord, ideally 24 months or 2 years prior to the expiration or renewal of your lease. Many doctors will misconceive that if your lease agreement was a 5-year or 10-year commitment with the ability to renew the lease for 5 more years, many doctors and tenants do not know that they can actually renegotiate terms ahead of the renewal of the lease. So if your lease agreement is expiring or is approaching a renewal date within the next 1 to 2 years, ideally closer to 2 years, that is the opportune time to reassess the lease, develop a strategy, and again, you can renegotiate terms with your landlord. Now, when we get involved in negotiation, there is a very scientific process that we follow from point A to point Z to make sure the process is done properly. And that involves getting a copy of your lease agreement, including all supporting documents, reviewing everything cover to cover to identify what are the risks and liabilities and what are the financial terms you're currently paying. We will also then have our in-house leasing team do research on rental rates, comparable properties in the area to determine and ascertain whether or not you are in fact overpaying in rent. And then when we formally commence the negotiations with the landlord, we generally start the conversation off about the financial terms of the lease because that's generally what is a priority for them in terms of conversations and discussions as it relates to the lease agreement. We will spend in some cases a few weeks, more often more than a month, negotiating the financial terms of your lease. That would include rental rates, operating expenses, tenant improvement allowances or inducements, including potentially allowances to renovate your office or a free rent period. And once the financial aspects of the negotiations are completed, we then move on to legal. This is where we'll negotiate changes to the assignment and subletting section, death and disability provisions, limitations on personal guarantees. There is a long list of legal items that we will review and negotiate to make sure the lease agreement does protect you and your family and your estate, as well as is structured in a way to facilitate the eventual sale of your business. However, we do understand that for many doctors, the first step is really to review the lease agreement and understand, really frankly, whether or not you have a good deal, and legally, is there anything that you need to be aware of that could be problematic for you or your business or your long-term plans. One of the services we provide is called a critical dates and risk analysis. It's essentially a review of your office lease agreement. What we do during the lease review service is we will have you email or fax or mail us a copy of your lease agreement. Our in-house legal team will review everything cover to cover to identify, are there any terms or conditions that could expose you to unnecessary risk or liability? Our leasing team will do research on rent rates and comparable properties. And generally, we'll set up a 60 to 90-minute phone call with you where we will discuss all of our findings with you. We will help you develop a strategy for the negotiations with your landlord. We normally charge a flat rate of $1,500 for this service. However, really as a courtesy for all of you taking time to join us this evening, this afternoon, we are offering all of you a complimentary review of your lease agreement. However, the offer is really only for this week. So if you are interested in the lease review, by all means, please feel free to take down my contact details. My office phone number and my cell phone number are there. All of you will receive an email following the webinar today. So if you are interested in the complimentary lease review, you can send me an email or you can call us at our 1-800 number or just reply to the email that you'll receive letting us know you are interested. We will make arrangements to get a copy of your lease and to schedule a conference call with you. Again, the entire lease review is complimentary. There's no cost. There's no commitment. It's really our way of providing you with some additional advice and thanking you for taking the time to join us this morning. And without further ado, I'd like to pass it over to Casey. And Casey, if you could take over, and Casey's going to walk you through how to essentially be better, more efficient business operators and managers, and essentially how to run a more profitable business. So I do want to thank you all very much. I'm going to be here, so if there's any questions, you can reply on the side in the question field. I'm happy to answer any questions, or you can email me directly. And I do hope all of you take advantage of the opportunity to have your lease reviewed. And thank you all very much for your time.
Well, thank you. And as Justin mentioned, my name is Casey Hiers, and I'm a director at Four Quadrants Advisory. And for the sake of time, I'm going to go ahead and jump right in and talk about what they didn't teach you in dental school. And quite frankly, that's the business side of dentistry. And I get to travel around the country, and I get to talk to hundreds of dentists, and I get to hear what's on your minds. And one question that I hear the most often is, how can I know if I am maximizing the profitability of my practice? And this is an important question, and really it's going to be the framework for what I'm going to share with everybody today. But first I want to start with a question, and that question is, why dentistry? So wherever you're at right now, just think back as to why you wanted to be a dentist. What was the primary reason that led you to dental school and to be a dentist today? Now, as you can imagine, when I present continuing education live in classrooms, I love hearing all the answers, and I've heard some doozies. But for the most part, the primary reasons people get into dentistry, they typically fall under some of the following areas. The first one is a lot of times you're following in a family member's footsteps, and that can be a parent, grandparent, aunt, uncle, or cousin. But there's a family member that was in dentistry, and people track that back to maybe they got their first interest in it. Others like the creativity of working with your hands. Some tell me that they got into dentistry for their desire to help others. The schedule and the lifestyle that dentistry can provide, I inevitably always hear that, and that's very relevant. I've also heard a lot of times that when folks are younger, they shadow a medical doctor and then they'll shadow a dentist. And they realize that dentists are far happier in terms of scheduling and lifestyle and things of that nature. So just think about the reason why you went into dentistry and what that primary reason was. One reason I rarely hear is that the primary reason for getting into dentistry was for your passion to run a business that day to day. Now, we'll come back to that. But before we do, I have another question for you that I want you to ponder. And that is, what are your biggest challenges? What are your biggest sources of worry and concern? What keeps you up at night regarding your practice? And as you think about that, I'll share with you what I hear as I talk to you guys and dentists around the country, and I inevitably hear right away patients and staff. And those are valid, and those are something that you deal with on a daily basis. But now zoom out and think about the bigger picture. Some of the challenges I hear the most from dentists, their challenges and areas of concern they typically have to deal with their cash flow, their practice account balances, tax surprises and their tax management. And some of you are probably dealing with that right now. Debt is always something that we hear. Retirement and retirement savings, and ultimately transition planning. And really these two questions I just touched on in terms of why dentistry and what are your biggest challenges, they tie together because while dentists are serial overachievers, most of your challenges, they come from the business side of your practice. And that makes sense because the business side of dentistry is not particularly your passion, right? To own a business and run a business, that wasn't typically the primary reason why you went into dentistry. The second reason is you received little to no business training in dental school. Think about it. How many of you felt equipped to run $1 million practice, right, $1 million business, when you left dental school? Most people say no. I've had a dentist or two raise their hand and say, they did feel like that. And then after about 18 months of running their practice, they quickly realized that they did not get enough training for that. But another issue is that most dentists bear the workload of 5 C-level executives. So besides just being the CEO and the COO, and even if you have a good office manager, the dentist is the COO. You're the chief financial officer, chief technology officer, chief marketing officer. You guys are bearing that workload, and that's on top of providing great dentistry. So as a result, we end up with statistics like I'm about to show you. And this is from the most recent survey from the ADA. And this is on dental retirement by the numbers. And on average, $26,000 is how much, on average, a dentist saves for retirement every year. If you're thinking to yourself, that's not enough, you're in good company because 96% of those surveyed said that they're under saving for retirement to maintain any sense of lifestyle that they want to have in retirement. But in dentistry, there's always that last payday, right? Selling your practice and hopefully making up that difference. Well, this statistic's not going to make you feel good. 80% of associates do not become partners. Now, I could present probably for another hour solely on this last stat of why associates don't become partners, but I'll sum it up like this. It's a false belief to think that selling your practice is going to make up your retirement or the majority of it. And as I go through this today and discuss some of these principles, really it comes back to consistent and predictable cash flow. And you can't produce your way to profitability if your systems and processes are broken. And we see it all the time. We see that $1.5 or $2 million practice where the doctor wonders where all the money is. And the question today is, are you maximizing every ounce of profitability from your practice? So in our work with dentists, we've been at this for about a decade and a half, and we only work with dentists all over the country, but we've identified problem areas that if they go unaddressed, they can absolutely crush your practice. So I want to discuss them today so that, number one, you can address them and continue to build a practice that you enjoy, but number two, that allows you to maximize your scoreboard. And we term scoreboard as your income, your retirement, and your net worth. And ultimately, we'll go around to some of the bigger dental shows, and it's all about product and procedure, and very few people out there are helping you with the scoreboard, with your income, with your retirement, with your net worth. And those are things that I think are probably the most important and what I want to address today. I'm going to go through some problem areas today, and this is just the tip of the iceberg. But we found that these problem areas, if they go unaddressed, that they will crush your practice. So as I go through them, do a self-analysis and ask yourself, how am I on these areas? Do I have my arms around it? Do I need work on it, or am I doing okay? The first one is high insurance adjustments. And everybody has a challenge with insurance. It just depends on to what degree. But high insurance adjustments, if not managed correctly, it can really, really hurt a practice. The second one is reactive tax planning. And we call it a tax surprise. And we define a tax surprise as being owed or refunded $10,000 or more. And I got to be honest, if these first two are problem areas that you look at, and if you have 15, 20% insurance adjustments every year, and again, that's your total patient population. We know that some patients are going to pay, 70 cents on the dollar or things like that. But if you look at your total patient population, all those on your fee for service and then those on insurance, if you're over 15% and you're having a $30,000 or $40,000 tax surprise every year, it's going to be really, really hard for you to get off that hamster wheel and to be a multimillionaire in dentistry and to be able to really retire on your terms. So those first two are tough. How about staff and hygiene inefficiencies? Is your hygiene department producing 3 times what you pay them? Do you even know what that ratio is? Because you should, and it should be around 3 times. How about low or fluctuating bank account balances? Think about a 12-month time frame. Think about your practice account balances. If you have $20,000 and $30,000 swings up and down, and when you check your balance, it's just as much of a surprise to you as what that balance is going to be. Again, that's a red flag. That's a problem area, and that alone's not going to take you down per se. But if you start adding all of these up, it's going to be really difficult. But that low and fluctuating bank account balance, there's an ideal bank balance, and I'm going to tell you what that is here in a little bit. How about paycheck-to-paycheck living and inefficient income structuring? Now, when I say those in front of dentists, it's not so much that your lights and your water is going to be turned off and you're not going to have food on the table. That's not what I mean. What I mean is, too often we speak with dentists and they say, I just take what's left over at the end of the month. Sure, sometimes I skip a paycheck and I'm not able to pay myself. Those should not be acceptable. And really it's the foundation of getting that financial freedom and getting your house in order is having your income structured correctly, having your practice account balances set up correctly so that you're hitting certain goals. So again, if you're one of those people who you just kind of take what's left over, or you're not really sure what you're going to get, or you get a quarterly bonus that sometimes is 0 and sometimes is 50,000 and it's all over the place, those are red flags. Those are some problem areas that, again, could potentially affect you to not being all that you can be. Lack of retirement strategies. This one's pretty common, and I get it in dentistry. You take on a lot of debt, and you're buying a practice, and you're buying equipment, and it just kind of kicks the can down the road. But we see it all too often where the dentist who's 55 and has no debt also has no retirement savings. And really, if you're a dentist and you're collecting around collecting around $1 million or more, you should be saving 6 digits. You should be saving $100,000 or more for retirement. But not having a plan, not having a strategy, just because you have a lot of debt, that's not an excuse for it. And so if you don't have a good plan around that, again, that's a potential issue. Lack of a comprehensive approach. This is a very general bullet point, but ladies and gentlemen, it might be one of the most important ones. Every dentist and specialist that comes to us, they already have a team in place. They already have an accountant and a financial planner and a business advisor, an investment person. A lot of times it's a friend or a neighbor or a relative. And what we see is typically a dentist will have their team in place, and they work individually in silos all around town, and they're not communicating, and there's no synergy with it. And that lack of a comprehensive approach, especially with a dentist and the way that dentists and their practices are set up, it's a real detriment. And that's one of the areas that we have found why we achieve such great success is because we have a comprehensive approach where everything is under one roof. Everyone's talking, and there's monthly adjustments, and it's really, really important. But if your team is working in silos and they're individually all around town and there's no communication, again, that can be a problem area that, if not addressed, can be a real challenge. So as you did this self-test, and I went through these quickly for the sake of time, but if you answered yes to these, or a lot of these you're not sure of, or you've got some issues with, again, just know it's going to make it very difficult for you to be a multimillionaire in dentistry. And I talk to too many dentists who, they're busy, they're seeing a lot of reports and a lot of big numbers coming through. They're wondering where that money is because they're sure not seeing it at home. And they just feel like they're on this hamster wheel, and they're not sure how to get off of it, quite frankly. And so it's important to have that self-awareness that if some of these areas you're struggling in, that there's something for you to potentially be better. I want to give a couple takeaways, things I alluded to earlier, but in terms of right-sizing your income, if you're someone who takes what's left over or isn't sure, the proper income structure for a dentist should be a set W-2 and consistent distributions. Now, it's going to be different for every dentist because every practice is different. But for example, we have a dentist who his W-2 is set, and then he has his consistent distributions that are set. So his W-2 is at $270,000, and then he gets a $12,500 distribution every month. And like I said, it's going to be determined by a whole dozens of factors, but that's how your income structure should be set up. And your current team should be able to help you with that, determine what your W-2 and consistent distribution is. And all too often we see people who are taking a distribution of $5,000 one month and $30,000 another month. And that's a real no-no. It's going to cause a lot of problems down the road. Second takeaway I wanted to show is practice account balance. When you have a practice account balance that's all over the place, what should it be? We say 10% of production. And so I'll do a little quick math. If you have $1 million practice, you should keep about $100,000 in your practice account at all times. For some people, you say, gosh, that's a lot. That's going to be hard to get to. And it doesn't happen overnight, but it's absolutely doable, and that's what you should have. Others of you say that's not very much at all, and have some dentists have 3 and 4 times that amount because they've been burnt by a tax surprise, because they don't have control of their financial house, and they never want to be burned again. So they're sitting on a bunch of cash. But hopefully these 2 takeaways can give you just a little insight into some proper structuring that can really help. The next slide, I think you've heard from me enough. I'm going to put a video on. I want you to hear from some of your peers.
Be very good at something in dentistry
from around the country,
the rest
and I
of the
want you
stuff,
to hear about their
financially,
experience here.
I don't know what I'm doing. I make poor choices, and I've learned to hire the experts.
I mean, across the board, Four Quadrants has exceeded almost every expectation on just about every level.
We're saving $200,000 a year, which is insane.
Make poor choices, and I've learned to hire the experts.
Across the board, Four Quadrants has.
Hey, can you
Since
guys
we've
hear
been with
that?
Four
I want to make
Quadrants,
sure the audio.
we saved $140,000.
In retirement, and I'm looking at just $30-some thousand
hear
a
that?
year and just going like doing the math on this. I'm like, there's no way that's going to happen. And
Okay,
it
very
wouldn't
good.
have
We'll
happened.
resume that. Thank you.
But they have structured things in such a way that it's going to happen.
I'm a lot more optimistic that we're actually going to be able to retire at some point and enjoy that retirement.
I'm amazed at how much money that we're saving and still living the lifestyle that we want to live.
When they give me their advice, I follow it. And it's worked. It continues to work.
I'm going to honestly say, probably other than my wife Jennifer, they're probably a group of people that I trust the most in my life.
Well, hopefully that's good for you all to hear from some of your peers as well. And I think that video summarizes it a lot. And those are all people that, you know, they wanted to get their financial house in order, and they didn't settle for status quo, and they decided to do a little legwork and see if they could do better. And they wanted to maximize the profitability of their practice. And so I think that's important. I want to get into a summary here. Really, you know, problem areas exist that can hinder a dentist and disrupt take-home pay, retirement savings, and higher net worth. Again, it's all about the scoreboard, and too often your time is being monopolized by things that aren't improving this, and it's a darn shame. And so when opportunities come along like this, when you can look at your lease or you can look at your financial house and improve, I think that's really exciting. You know, again, dentists are overachievers, and you go into dentistry for reasons other than wanting to run a business. And even if you enjoy running a business, your money's made in the chair, and that's where you're going to do your best. And if you can have a comprehensive team that has your back, the upside is really, really impressive. And I know that because every day, you know, we see that around the country. And really, if you treat the business side of your practice with the same expertise as the clinical, it can make a 7 or even 8-digit financial difference by the end of a dentist's career. And that is that's a big deal. And on average, our average client collects around $1 million. They take home $400,000. They save an additional $100,000 for retirement. And it's not about producing more or changing your lifestyle, but it's about maximizing what you have and getting your house in order. On average, proof's in the pudding, and we did an internal study of our clients, and on average, our clients in 36 months, they see 11% overhead decrease. They see a 25% increase in their annual income. Here comes a big number, 670% increase in retirement savings. And we have people all the time that they come in saving $15,000 or $20,000 a year for retirement, and by year 2 with us, they're saving $120,000 or $130,000. And I've got some great stories around that I can get in deeper with offline. But my favorite number on this is achieved with an annual average increase of revenue or production of 1.7%. Most of your careers, your accountant or your practice management person, they just say more, more, more. Not about more. It's about better. And that 1.7% is a really exciting number for me. I've got one more short video. This is an oral surgeon who has been with our firm for 1 year.
My dad, he instilled in me to be my own boss. I always wanted to be a surgeon. I spent many summers working in hospitals. And the thing that struck me was most of the physicians did not have a great life. They were at the hospital all the time. A number of them were getting a divorce. Along that same time, my wife was studying to be a dental hygienist and said, you know what, you might want to give dentistry a look at because you could do oral surgery. So I went back and decided instead of med school, I would go to dental school with the idea of being an oral surgeon, and everything's worked out. Susie grew up across the street from my aunt and uncle. She was my sister's friend back in the day, and then we moved from Indianapolis to Arizona. I came back for a family function, and Susie and I were seated next to each other and struck up a conversation, and we went out once while I was in town. Then I went back to where I was going to college, and we finally started talking, and then when she went to IU, I transferred to IU.
He just asked my dad, while I was in the kitchen, and my dad was watching TV, and he said, I want to ask you for Susie's hand in marriage. And my dad said, you could have all of her.
We've been married for 37 years. I had been in practice since 1989 in my own office, and we were a successful practice. I had an accountant who was the head of one of the top accounting firms in town. I had a company that did my retirement plan. I had a payroll company, and we were just not getting results over the last number of years that I thought we should be getting. I was just another person that they plugged my data in. They offered no suggestions, no advice, and I've been receiving things from Four Quadrants. Kind of glanced at them, but I thought, you know, it is so hard to change your advisors and your accountant, and I just was kind of pushed over the edge on just a couple of things that happened. I said, you know what, I'm going to give them a call. I need somebody who really understands my business, and that's why I switched to Four Quadrants. I've been with Four Quadrants for 1 year now. I can tell you my experience has been excellent. They understand dentistry, they understand the oral surgery, they understand the equipment, the supplies that we need. So it's nice when I look at buying a new piece of equipment that I can call up Four Quadrants and say, hey, does this make sense for my practice? My old accountant probably would have said, if you want to buy it, buy it. The best news I heard today was that not only did we meet the expectations they had for us as far as savings this first year, but we exceeded it. We were almost double what they thought we would do. And when they looked at the numbers by the time I retire, it's a staggering amount compared to where I would have ended up with my old advisors.
I really like them personally because they are in touch with Larry and I. And I really appreciate the fact that they've included me. I feel like an integral part of, what's happening. And I really do appreciate that.
I sometimes relate this whole thing to playing golf. You need a good coach. Even the professionals use a coach. And that's what Four Quadrants is. They're a coach to keep you hitting the ball down the middle. Most of the time, we're all going to have a few bad shots, but they try to keep you from having many bad shots. I would highly recommend Four Quadrants because they care about their clients. They've helped us this first year. We have increased production, increased collections, decreased expenses, and double the amount of money we were putting away the year before. They are a top-notch company, and I highly recommend them to anybody.
Here's the good news on fourquadrantsadvisory.com, which my last slide will show. On our website, you can go to fourquadrantsadvisory.com, and that is one of the dozens and dozens of client stories we have on there. And so before I turn it over to Justin, I just want to thank everybody for listening. Hopefully something I said sparked a little interest, and it's something where you can reach out to me. I'd love to do a complimentary practice evaluation and see if there's some profitability that you're missing out on that we can help you with, or really just ask some questions. So please call or email me, and I would love to go through that. At this time, I want to thank everybody, and I want to turn it back over to Justin to close us out.
Yeah, and Casey, really appreciate it. The videos are incredible, by the way. And doctors, do want to thank everyone for their time. As Casey had mentioned, the key really is having the right advisors and the right coaches and the right team there to help you. I would imagine all of you could probably benefit from a consultation with Casey and the Four Quadrants team, and all of you who do rent or lease your space or are considering entering into some type of leasehold arrangement. I would highly recommend you take advantage of the offer-free complimentary lease review. Again, it's normally a $1,500 service. It's about an hour-long phone call, so would certainly encourage all of you to take advantage of the consultations from both Casey and myself. Our details are there if you want to reach out to us directly.